Hi, I'm Jonathan Bays, and this is our August investment market update. Well, being August, we're in the midst of reporting season. We've had already a couple of weeks of US reportings through, and in the headlines you would have seen the likes of Google and Amazon and Tesla and Apple all reporting numbers. They're a mixed bag in the US. We had good numbers out of Amazon. In fact, we actually had a strong quarter profit growth from Amazon. It's been a company that's really showed a lot of top line growth, but not very much for shareholders at the bottom line. But that changed in the quarter, and the market liked the results. We also had some really good numbers from Google as well. Artificial intelligence there playing a role in search engine profitability, delivering better results, in fact, for consumers. And counterbalancing that, unfortunately, was Facebook, and that fell over 20%. I guess it goes to show that these stocks can fall indeed when they start to display, I guess, some evidence of a peaking or a saturation in their markets. Facebook saw subscriber numbers in America and Canada flat quarter on quarter, and in the European markets they actually went backwards. Actually, one stock that has also been in the press a lot lately, both as a positive and as a negative, has been Tesla, and they actually managed to surprise a lot of the naysayers in the last quarter. Focusing on the quarter ahead, they actually said they'd be back at cash flow break even and profitable in the third quarter, which has certainly dispelled some of the concerns on the stock, and it jumped about 15 or 16% after results. We're about to move into Australian corporate reporting season. We get the banks starting in the next week or 10 days. We've got some hopes for Downer Group, particularly in Australia on the cyclical side. Again, the infrastructure spend locally here is still very, very strong. So thus far into reporting season, markets are holding in there reasonably well. In Australia, we're loitering around a decade high and have done so for the last 6 weeks or so. The only thing sort of holding us back from pushing higher is valuation, I guess, in many of the cooler parts of the market, but also too concerns in China about the impact of trade protectionism. Share markets bounced a little bit through the latter part of July, but then they unwound that, and Chinese shares are back at the lows that they were at back in June, and that holds back, I guess, some of Australia's export sectors, which are certainly influenced by the expectation for Chinese growth going forward. In July, we had some success in the local portfolio with Afterpay. That jumped from about $10.50 or $11 the previous month to as high as $16, and currently trading a bit over $14. They gave us a bit of a trading update midway through the month, which seemed to excite investors, particularly about the US growth strategy, which is now underway and has been so since May. We feel pretty encouraged by it. The stock's definitely starting to get up with events, but we do think over the medium term it can be worth over $20. We also had a really good update from IWF, who've been under a bit of pressure post the Royal Commission. They had a decent set of figures with regards to funds under administration, but also two new investment funds coming on board. With the shake-up in financial services at the moment, there is a lot of movement going around, and IWF seem to have captured their fair share. So as we embark, I guess, upon the next couple of weeks of Australian corporate reporting, we're hopeful for some positive outcomes. I guess the one area where there might be some uncertainty remains the banks. Just the last weekend gone, so early August, we saw auction clearance rates drop to a new 4.5 year low. I don't think that sentiment on the housing market is going to help the banks anytime soon, as I guess I've highlighted in recent monthly notes, but the banks could use the current weakness post the Royal Commission as an opportunity to rebase their dividends. And payout ratios in the banking sector have been high for many, many years, and much has been made of it. But with a more, I guess, downbeat outlook for profitability in the next couple of years, it might be the right thing for the banks to lower their dividends just a little bit going forward. Fortunately, in the case of ANZ, Westpac and NAB, we don't get full year results, only CBA report. We just get trading statements, but it'll be interesting to see whether CBA leads the bunch with a modest downgrade to its payout ratio and its dividend. And that, in fact, could be the reason that takes the banks a little bit lower in the course of the next couple of months leading into the end of the year. I still think, as I've said time and again, that the banks are still 10 to 15% above the ultimate low that they'll reach through this housing cycle. But anyway, sorry to leave it on a somber note. The rest of the sector should actually be pretty good, but let's see how things go with the banks.
Well, in terms of the domestic Australian economy, we think the Reserve Bank of Australia is on hold for an extended period. You could argue that the Reserve Bank is comfortable with some of the froth coming out of the housing market, particularly in places like Sydney and Melbourne. Remember, house prices are the number one store or value of Australian household wealth. As long as those prices are trending lower, the Reserve Bank is not going to raise rates. And if anything, they're more likely to ease than they are to raise interest rates. Why do we think that? Wages growth in Australia is at or near record low levels. Household debt, as measured to GDP, is the second highest in the world. And thirdly and finally, some of the tailwinds that have supported the Australian economy in the last several years are starting to turn against us. So we think about trade, we think about some of the frictions between the United States and China. That is at the margin likely to be more negative for the Australian economy. Generally, the environment remains one where yields are still low. Globally, there has been some move higher in bond yields in the last 6 to 12 months, particularly in the United States, but generally they're still at very low levels on a multi-year basis. And at the same time, the interest rate duration or sensitivity of major bond markets to changes in yields is at record levels. So what that means is you've got very low income, you've got very high price sensitivity of bond prices to changes in interest rates. That demands a different approach, it demands more flexibility and being more nimble to take advantage of different market opportunities as they arise, rather than sitting in a purely traditional benchmark-driven bond portfolio where we see more constraints and difficulties going forward because yields are low, because the potential for capital loss is high if interest rates rise.